bit. I don't think it's going to be a really long one. I try not to keep them super long because I feel that you don't remember enough. You don't take stuff on if things are too long. People become distracted and detached from what's going on. So we're not going to make this super long, but it's something that we're following on the theme of doing stuff about debriefing. I wanted to try and do something a bit different in terms of what I wanted to cover, because I've always been very much somebody who's a big believer in having a good structure, a good methodology for how you do things, and something that I've tried to, or I'm trying to adapt to a little bit, is bringing a slightly different way of looking at things into it, and a little bit of what I call a more creative approach. And I know Alex talked about this in his first session. So what I don't want to do is end up going over what Alex said too much, but what I want to do is kind of give my take on this slightly more creative approach and give you guys in a way, a little challenge or a little something to have a go at, which will lead into Friday and let people, whoever's fancying having a go at that on Friday, feel free to do so. But I'll talk through a little bit more and we'll kind of grasp a little bit on that. But that's the kind of bit that I want to cover. So Eric last week covered the sort of efficiency and how to develop trade ideas and how to track ideas, how to sort of break down structure and make that more efficient, easier to do via a spreadsheet type process, which, everyone needs to adapt their own version of that. And there's no point in me saying this is exactly how you do it. And I hope for those of you who've gone and looked at the way Eric approached it, have taken that and said to themselves, okay, well, how do I do this my way? How can I adapt this and twist this and make this what I want it to be and make it work for you? And that's what you need to do. For anything, you've got to make it your own. Otherwise, you're always going to be stuck trying to replicate somebody else's approach, trying to replicate what someone else does. So what I want to have a look at today really is trying to bring a bit of creativity in things. I'll talk about the purpose of doing that as well, because I think it can often be seen as either unnecessarily vague and trying to cover things that you're just not going to be able to cover, and sort of covering off every eventuality, which is always something I've struggled with as an idea. But it has a different purpose, and the purpose I will explain in due course. The thing is, what we end up doing most of the time, we talked about various traditional methods, and we're not going to go in loads of detail on it, but most of the time, generating ideas from a debrief or generating new trade ideas follows a reasonably consistent type of approach, reasonably consistent type of pattern. And what we end up with is debrief, whereby you're collecting ideas. That's the purpose of a debrief. You're trying to collect as much ideas. You're trying to put an end on the day, and you can kind of wrap that day up in terms of different metrics to judge it, different information that has come in terms of narrative. We know, and we've explored so many different ways of going about this, and different people who do it very well from an extremely structured point of view, other people who keep a more sort of diarized type approach to it. Ultimately, the point of doing that is to improve your ability to remember things, to categorize things, to sort of code them, if you will, into your own language, your own way of seeing things. And that way, it makes it very easy to find different patterns. You go, right, I've seen this before. What was the context? How did this type of idea come about? Can you find similar type scenarios? Can you create a kind of template for which you can then look for future scenarios as well? Once you've got a rough idea of what your trade is, you can find it in future. It pops up again and you're like, right, well, I can adapt this slightly. I can change that a little bit because that doesn't really matter as much as I thought it did. And you sort of incrementally improve your trades. And that's a very traditional way of doing it. Ultimately, what you're trying to get to is a point where the trade is very well defined, and then it's just a case of marginally refining your trade along the way. And that ultimately is around about what you're trying to get to. You then add color onto this as well. I probably should have done this as a animation on the PowerPoint rather than having it all up for you guys to read ahead of time. But yeah, the next bit is you start looking at what the situation is, how the narrative's developing that allows for certain trades to play out. Something I just talked about on the debrief was about using data to give yourself a trade. And this isn't something that I think is a massively new thing to anybody, but today I thought was a great example. Thank you, Alessandro. I feel it's often you who points that out for me. But no, I wasn't sharing my screen, so my apologies for that. There we go. We're back in business. But it's something I talked about today in terms of using the structure, using the current narrative that PMIs in Europe aren't massively what people are clutching hold of at the moment. And all the focus is still very much away from Europe. And so the PMIs today provided a great opportunity of using narrative to give yourself a chance to buy bonds. Equally, gave yourself a chance to sell equities. And you could see there the difference between how significant the move in equities is compared to the bond moves. And so you can then start adding color to any kind of debrief, and you get to enhance the way you approach things and make it dependent on correlation and volatility as well. So you can constantly add more and more information. But the whole point of this sort of very standard methodical approach is that you create a very clear representation of what your trade is. And this is something that I think a lot of people don't do to start with. I often sort of challenge people on, they say they have a trade idea and they like to play certain types of trades. I spoke to someone recently about it and they said, I like to play reversals. I said, okay, can you define what you need to see? What is it that you want for a reversal? And they talked about various different metrics and ATR, fading when we get to highs, things like that. And I said to them, well, the problem with that is you cannot definitively tell me what to do. If I came into this and said, how am I going to play a reversal trade? And I went off what you'd written. So this was an email someone sent me. I couldn't take a trade on. I would not have any idea when to execute, what exactly I'm looking for, how to identify the trade, how to not just then go from identification to access the trade, what you need to see to get you into the trade, what you then expect to see once you're in the trade. And that's what we've talked about this before in terms of debriefing and what you're trying to get to. I think Eric made that very streamlined last week. So that's your kind of traditional method. And this then produces a reasonably clear structure. This is the gold on the other day of the attacking the volume ledge trade, whereby you have a clear idea of what you're after. We got that volume ledge build up the day before on the cash session. We then got that volume build again. So you're matching up the order flow, you're matching up the structure. You've got an idea of where we can move to. So you've got all of those bits and pieces into the trade. And this then starts to form your standardized approach to the trade. You're kind of, here it is. This is exactly what I'm looking for on a volume ledge. This is what I want to see when it breaks. This is what I expect to happen afterwards. And you then add wider structure to that. The inside week break that we had on gold that allowed for that bigger movement. You can start adding and stacking all these bits of information on it. And your debrief ultimately comes then down to, rather than it being and it should always be a job of finding new trades, but rather than just be entirely about finding new trades, you can refine this further. How do you play for this move? What did you have to do in this area to be able to actually get the meat of the move? Because the meat of the move was the inside week break above 29. I think a lot of people weren't necessarily in because they got the early action, the bit of jump that ultimately gave us 50 plus ticks up here, and many people then weren't in for the continuation of that type of movement. And this is what it looks like on a 1 minute. So you can then refine it down, break down what it is that you may have needed to appreciate in the way that this traded. The fact that you kind of built another volume ledge higher up, which allowed for that inside week break and that bigger move. But what you're doing there from the debriefs, you're then refining and understanding this trade in a little bit more detail. And what this ultimately is slightly backwards looking. That what you're doing is you're seeing a new variation of the way it trades. And you're looking at that and saying to yourself, okay, it doesn't break and fly like, you know, probably your first iteration of this type of trade, because that's the most noticeable version. The most noticeable version of a volume break or volume ledge break is where it trades up to it and it goes pop and whips straight up and it bang and it just goes. And of course, that's the first thing and kind of the main thing you're after. That's what everyone wants, to trade that goes pop and flies on side. So you then see this and you go back over this and you go, okay, well, what happened in here? How did I approach this? How did I deal with the pop and then the very sideways trade? Knowing that I've got that structure above, how did I cope with it? How could I allow myself to stay in this trade? And that helps you then formulate a different variation of how the trade plays out. It's not just bang, go. It's pop, struggle, 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 and then the release. And that's fine. You develop a new idea. You've now got, you know, a volume ledge break and trend. And then you start to look at how you could play that and the different variations of that. And this then leads you to have different variations of the same trade, similar type scenario, but done over an overnight session. You have a volume ledge. You know that this isn't going to be the high. You're going into the next day thinking, yep, this is going to go, break the high. What happens when you gap up? How do you play it this time? So there's a new variation of the trade. And that's the very traditional way of looking at it. But what I want to try and get people to think about is already being there before you have to see this new variation of a trade to then learn what that is. And the way that you're going to be doing that is by a little bit more of a creative approach. We'll get onto that in a minute. Because I wanted to have a look at this one in the S&P. And I'm sure, well, date-wise might give some people a clue here. But this was after the Fed. And it was one trade that I thought, pretty confident without exception, nobody took the short reversal on the first failed break. And a lot of people, I felt, was kind of a caught in the headlights moment for a lot of people, where what they thought should happen happened and then almost instantly got taken away from them. There wasn't a chance to see it going wrong and give it up. It was a case of it went wrong, and that was it. And that, I think, for a lot of people, they got very burnt on that, and then that also influenced people's second attempt on the trade. Now, if you've gone down the route of the very sort of standard form trade, your representation of what this should do, you accept, and hopefully all traders do this, and you accept that this doesn't work every time, and you will lose occasionally, and that's fine. And so what then happens is it allows you to then put this into the category of, okay, didn't work, accept that. Yeah, didn't happen. Of course, it's not going to, you might win 80% of them, but this is one of the 20 that went wrong. And I think this was foreseeable. So I don't want to say that this was some kind of new trade that, nobody could foresee, but it's the pre-planning of the idea as it's happening. And that sort of creative thought about how could this happen? What could happen here as you're going into it? And the sort of forethought of the different scenarios. Often what we do, and this is quite natural as people, is we look at something and we go, right, this is what I think is going to happen. And so you're looking at that happening, and then you react if it doesn't happen, rather than looking at it from the point of view of going, I know what should happen. What are the things that could change? What are the ways that this might not work? How, in a way, how could I get screwed here? And of course, no one wants to do that because everyone's looking at it going, yes, this is the one. I know what's going to happen. This is going to fly. And here, anyone who's looked at this and gone, how can I get screwed here, is now able to sort of look at that and go, I can see how this might happen. This was, you can see it, and I'll bring the ladder up on it and you can see what happens here. Put it over there. You know what the trade is here. You see all the volume coming in here, and what you can be looking at is you're thinking to yourself, yeah, well, we know what we're going to do here. You're going to see it up to 50, bang through 50, and this is going to fly. And I don't think the surprise side of it is that much of a surprise that it could trade through, fail to find any more buyers and roll back over. But the way it did it was absolutely not what you would normally expect. And it's this kind of thinking about, okay, how could this go wrong? And specifically, how could this go wrong? And what you got on this one was this almost instant, it goes wrong. So started off slightly earlier than I perhaps needed to here. And you'll see this pop. And this way you're sort of watching it, you're thinking, right, it's getting trapped, it's getting glued up here. We're looking for the break. That's what you're after. It backs off again. So you're very aware that this is backing off and backing off and backing off. So you could be looking at this thinking, right, well, rather than try and hit it at 50, let it jump and then buy it. So you're giving yourself alternate ways of entering the trade. But what then happens, there you go, we're up through 50, trade 52, 53. This is where you're thinking, yeah, I can buy this. Boom, it's instantly back at 50. And by the time people have kind of caught their breath and sort of thought, oh, what's going on? It's 47. Now people are panicking. It's 44, 43, 42. So fast against them. And once you've seen it, you can then go, okay, this is a variation. This is one other way that this trade could go wrong. And you're now aware of that risk. And it's not to try and scare you. It's to look at it and go, okay, these are different things that could happen. This is, yeah, and so how can I perhaps then go and deal with it? Because the trade works out a little bit later on, and you perhaps deal with this in a slightly different way. So if I think back, there we go. We'll see it on the one where it actually breaks, and it breaks slightly differently. So you're now aware of the risk on this. You kind of look at this and I know how this could go wrong. Actually, you've just seen it happen. Point that I'm trying to make here is you can, by forcing yourself to think about how things can go wrong or how things could vary in the way that they work out, you're giving yourself that ability to adapt in the moment, that ability to kind of come into this and go, oh, it's not worked how I thought. But rather than being surprised by it in this sort of rabbit in the headlights moment, it's more a case of it goes wrong and you're much more calm and much more able to then deal with that, because you're able to adapt your plan as the move's happening. I know that it was almost instant, that drop back, but when it traded 53 and suddenly it's trading 50 and 49, that should really quickly be saying to you, this doesn't look great. And the moment you went tick, tick, 48, if you'd kind of already planned the idea, you're already feeling a little bit more comfortable with just going, this is it, get out. Because if you don't, you know that there's a lot of people playing for this, playing for that break. And therefore, you know that this is going to, or you can see how this could rip back on people if it goes wrong, because everyone's going to get trapped on the same trade. And the hard bit of that was not that you could, seeing that was possible. It was the whip back that kind of shocked everyone. And it's, this element of surprise that people don't usually deal with very well. And so when it surprised people, you knew what you should do, but because of the way it did it, I think a lot of people stalled, and that caused a bit of problem. This is looking a little bit more like you might want on a break, but then you adapt as well. And you can start looking at this as, we know that it's struggling up here, and then it trades 53. Once it breaks 53, now you think, right, I know the danger. But if you can buy 53, it's above the previous high where that little spike came. If you find buyers up here, this should go. And you can then look for the next leg of the move and play this like you normally would. You then get the little stop, the move's on. So you're seeing there a slightly different variation of how it plays to the upside. It's not just about buying from 50. You can play it from 53 as it breaks that kind of what I call acceleration point. The failed attempt one way, that then as it goes back is the opportunity to get in. Also, as it goes back through that failed attempt, so back through the 53s. And so what I'm trying to get at here is by scenarioing up various different ways that things can play out, you're giving yourself the chance to be ready for something that you wouldn't normally be, because you're kind of going off a standard form and a standard approach to things. And so it's about giving yourself that chance to a little bit not go dreaming on trades. And it's something that I would have been very anti probably a year ago or so. And it's only having a little bit more of a read and sort of something that I've tried to do myself, open my eyes to a few different ideas and different approaches, is to then sort of go, okay, well, let's have a little movement into the unknown and into the off the beaten track scenarios and ideas, because this way you're not trying to hypothesize or scenario up something that could actually happen. You're trying to give yourself the chance to, by thinking through various different ideas, give yourself that ability to see something different as events actually sort of unfold.